Well, markets in Asia and Europe reacting positively this morning to the Fed's new steps to inject liquidity into the frozen financial markets. The Fed will lend up to $200 billion to 20 big financial firms for about a month. Now, the hope here is that this will get banks to increase lending to consumers and businesses, and that consumers will start buying houses and the businesses will start making deals. But will the Fed's plans work? Here with some answers are William Smith, the president of SAM Advisors, Roger Aguinaldo, who is the CEO of M&A Advisors, and Fox Business contributor Eric Bolling. Welcome, guys. Eric, let me start with you. 400-point pop yesterday in the Dow. What is this rally telling us?
Yeah. Yesterday afternoon, we were sitting upstairs kind of brainstorming. Is this all the trade numbers? Is this all maybe the dollar finding a home? Is this all the financials feeling well? Or is it the Fed action? And I keep coming back to the fact that the Fed has been vigilant. They're obviously doing everything in their power. So the next question was, where is the all clear sign? I said, well, for who? For me as a trader or for the general public? And they said, how does everyone watching this show in the morning, how did they find out? When is it clear for them to jump back into the market? And I said, well, I would say clearly when the M&A activity starts to pick up. What does that mean? When you start seeing deals, big deals, I'm not talking about the little deals that are continuously going on. I'm talking big multi-billion-dollar mergers, acquisitions, spin-offs, things of that nature is the all-clear signal, I think, for the general public to start to get back into the market. Now, very interestingly, the Fed injected liquidity into the market. They've done that before. They've opened the discount window. They've lowered interest rates. In other forms, they've allowed liquidity to seep into the market. But this time, two things happened differently. This time, the ECB and some of the European banks are involved. They're doing it simultaneously, a concerted effort. And number two, I think this is really clearly the most important part is that they did it by swapping, allowing a mortgage swap. In other words, the thing that's really seized up our markets are the CDO market, the mortgages. Yeah. But the Fed will take that as collateral, and that is huge, guys. That basically puts a bid in the mortgage market. When a bid gets in the mortgage market, all things start to move, and I think you saw that with the 400-point move.
So hopefully it'll clear out the mortgage market, which has been locked up, the securities backed by these mortgages.
Because there was no bid. Right. All these hedge funds were holding these mortgage-backed securities going, I have to get out, but I can't find a price.
No buyers.
There's a bid in the mortgage market.
Well, we have a guy here who can answer this question about M&A for us.
Right.
Roger,
Yes.
What's going on in the M&A market? Are you seeing any signs with not just what's been happening recently, but with the other Fed interest rate cuts thrown in there, any signs of new life in the M&A market?
Well, I would have to agree with Eric. If you put in liquidity when it's being bogged down by mortgages and with other financing instruments, mergers and acquisitions are not likely to happen because there's no financing in the market. There's no liquidity. It doesn't matter what the interest rates are.
Right.
You can have
nobody's lending.
If no one's lending, it doesn't matter.
No deals.
It's like having a gallon of gasoline for $2 a gallon, but no gas station is pumping this gas for you. So now there's liquidity in the market. It's up to the banks to start lending this money. They have the opportunity or the option to lend. There's no, the Fed isn't saying you must lend to M&A transactions. They have the opportunity. The liquidity is there. I think, in a sense, what banks are going to do is they're going to say, okay, where's the backlog of financings? Where's the backlog of M&A transactions? That's not happening because we didn't have.
But Roger, here you're an M&A advisor.
Yes.
Is your phone starting to ring more in the last?
What,
24 hours.
24 hours.
I would say over the last since December, things have slowed down. Not only with us, but with a number of people in the industry. The markets, financing markets, have shut down for the larger transactions.
So your phone has not started to ring yet.
No,
all right. So you're stand by. All right, Bill, what is your take on all this?
I think Eric and Roger are both correct. As far as you have to relieve the stress in the credit markets. Once that's relieved, and you saw the asset-backed securities, the mortgage-backed securities yesterday pop anywhere from 10 to 15%. I think that's going to relieve some margin calls with some of those funds in particular. Number two,
translate that for the Main Street investor. What is it? Why do we care about that?
Well, what you had was forced selling that was pushing down the value of a lot of these securities. So once you take that away, that will restore some stability to the markets, and then you can move on to the M&A part of the equation. So I think that this is probably putting in a decent floor. I'm not sure when the M&A activity will actually come back.
Eric,
real quickly, can I ask you guys with the downdraft in M&A activity. It's really been seized up. It just, if you remember last year at this time, deals were announced 2, 3, 4 a day.
Billions and billions.
And there have been no real major deals announced. A lot of us trade the equities around the M&A group. In other words, Bear Stearns, Goldman Sachs, some of the other big banks. That's got to be pressure on their earnings. I mean, how far forward are we going to see earnings pressure on some of these stocks? Because I own some of them, by the way, and I'm worried that their earnings aren't going to look good maybe for 2 or 3 quarters from now.
I would be worried as well if I were holding.
How are your earnings, Roger?
Well, you gotta take a look at it. There's a number of factors going on here. One factor is last year you had financing that was there was covenant light deals. They didn't care. They just wanted to lend all this money out. Now you're getting a pullback in the types of transactions that happen. Valuations need to be adjusted in the marketplace. Remember, M&A transactions, especially for private transactions, a number of these are private deals as well, and for private equity, those valuations need to be adjusted somehow in relation to the financing that's available. Now you have to figure out what financing is available, how it's priced. Then you go back and say, okay, is this valuation the right valuation?
But that will turn into lower earnings for the Goldmans, the Bear Stearns, and some of the other investment banks on the street?
That's being reflected right now already, though. We're buying Goldman Sachs, Lehman Brothers, Citigroup. We think all of them offer opportunities because their earnings are going to be cut, but that's also why you've seen their stocks get cut in half already. So I think, looking forward, I think it's a decent opportunity.
All right, Bill, Roger, Eric. What's the
big deal?
Look for the big deals.
With the B,
as
billion.
the canary in the coal mine here. On a positive way, that things are turning around. Watch the mergers and acquisitions activity. If it starts to kick back in, that could be a good sign for the markets. All right, guys, thanks so much. Well, the Fed is slated to meet once again on March 18th next week, and it is expected at that time to cut interest rates yet again.